Stop what you're doing right now. This second, put the coffee down, silence your phone, close the extra tabs, sit up straight, take a breath, now lean closer to the screen like your financial future depends on it, because it does. And yes, that text can wait. She will never match you back. Are we clear? Good. If you own silver, do not sell a single ounce until after you finish this video. I do not care what the price ticker says. I do not care what some analyst on television told you. And I definitely do not care what your neighbor's financial advisor thinks about taking profits. Something is breaking, not slowly, not quietly, but all at once, behind the scenes, where most people never think to look. Inventories are vanishing, deliveries are stalling, and the people who swore everything was well supplied are suddenly very, very quiet. Ladies and gentlemen, this is Paper to Atoms. It is January 27th, 2026, and I'm about to tell you something that should be mathematically impossible. Yesterday, January 26, 2026, we talked about stress in the physical silver market, we talked about shrinking exchange inventories, we talked about rising delivery requests that the system was clearly not prepared to handle, and I told you that the paper market was walking on a tightrope stretched over a canyon. I told you that when physical demand and paper supply finally collided, the break would not be gradual. It would be violent, it would be sudden, and it would expose just how little real metal is actually backing the mountain of contracts traded every single day. And you know what happened? The inventories didn't stabilize. They didn't rebuild. They didn't quietly recover like the talking heads promised. They collapsed. Overnight, the very warehouses that are supposed to stand behind the global pricing mechanism for silver reported another massive drawdown. Not a trickle, not a rounding error, a gut punch. At the exact same time, across the world in China, physical premiums surged again, meaning real buyers with real money are scrambling to get their hands on real metal. Yesterday was stress. Today is strain. Tomorrow becomes something else entirely. Because what we are seeing now is not just tight supply. This is a system where the paper claims are multiplying while the physical foundation underneath is being drained bar by bar, ounce by ounce, and the people who run this system are hoping you never connect those two dots. But that is exactly what we are going to do today, because today's data does not just confirm the trend, it accelerates it, it exposes it, it makes it undeniable. Here's the thesis, and I need you to hear this clearly. COMEX silver inventories are down roughly 70% from their peak levels. At the exact same time, physical silver premiums in China are surging to levels we have not seen outside of full-blown supply shocks. The same metal, the same global market, the same 24-hour pricing system, and yet two completely different realities. In a functioning market, this is impossible. Let me explain why. If silver is truly abundant, prices should be soft everywhere. If silver is truly scarce, prices should be rising everywhere. Arbitrage, the simple act of buying low in one place and selling high in another, should close any gap almost instantly. That is how markets are designed to work. That is how they have worked for decades. But that is not what is happening. Instead, we have collapsing visible inventories in the primary Western paper trading hub, while physical buyers in the East are paying significant premiums to secure real bars. The same silver, the same day, the same global system. But the price signals are diverging instead of converging. That tells us something critical. Price is no longer being discovered by physical supply and demand alone. It is being distorted by leverage, by paper contracts, by a system that can create supply with a keystroke even as the real metal is being drained out the back door. And I'm going to prove it to you with numbers, with data, with evidence that even the most skeptical person cannot deny. So buckle up, focus. Let me show you exactly what happened. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. As of this morning, registered silver inventories on the COMEX, the category of metal that is actually available for delivery, sit near 38 million ounces. Just a few years ago, that number was well over 120 million ounces. That is a decline of roughly 70%. The same exchange, the same vault system, the same global pricing hub, but dramatically less metal that can actually leave the warehouse. Now look at the delivery side. In the most recent active delivery cycle, more than 14 million ounces stood for delivery in a single month. That means an enormous chunk of the remaining registered category is being spoken for by buyers who are not rolling contracts, not closing positions, but asking for bars. Physical bars. Metal that has to be moved, weighed, and signed over. Let me say that again so it sinks in. With only around 38 million ounces registered, and over 14 million ounces demanded in one delivery period, more than a third of available supply was effectively spoken for in one shot. That is not normal flow. That is not routine hedging. That is stress. Now compare that to price. COMEX silver futures have been trading around $41.82 per ounce. That is the number on the screen, the benchmark number quoted on financial television, the number most analysts use when they say silver is well supplied. But in Shanghai's physical market, wholesale silver has been changing hands closer to the equivalent of $46.30 per ounce after currency conversion and local premiums. In India, large bar demand has pushed effective prices near $47.10 per ounce in major bullion hubs. That means we are looking at a $4 to $5 per ounce spread between Western paper pricing and Eastern physical pricing. On a $42 metal, that is roughly a 10 to 12% premium. In modern electronically connected markets, that kind of gap should be erased quickly by arbitrage. Traders should buy where it is cheap and sell where it is expensive until the difference disappears. But it is not disappearing. It is persisting. In some regions, it is widening. At the same time, open interest in COMEX silver futures remains extremely elevated relative to the amount of registered metal. There are well over 150,000 active contracts, and each contract represents 5,000 ounces. That is more than 750 million ounces of paper claims tied to a delivery pool under 40 million ounces. Even knowing most contracts are cash settled or rolled, the leverage ratio is staggering. So here is what has happened. Inventories have fallen, delivery demands have risen, physical premiums in the East have expanded, and paper claims in the West remain enormous. All four of those things have happened at the same time. That combination does not signal balance. It signals tension. And this is where it gets really interesting, because when you see shrinking supply, rising physical demand, widening regional premiums, and extreme paper leverage all at once, you are no longer looking at a normal commodity market. You are looking at a system being stretched to its limits. Now, let me put this in perspective, because I do not want you to think I'm exaggerating. We have had tight silver markets before. We have had shortages, panics, squeezes, and speculative frenzies. But what is happening right now does not line up cleanly with any of them. Go back to 1973 and 1974, when inflation was ripping through the global economy and precious metals were exploding higher. Silver ran hard, demand surged, and inventories tightened. But the pricing mechanism still functioned. If silver was expensive in one region, metal flowed from another. The arbitrage worked. The pipes were open. Look at 1980, during the Hunt Brothers episode. Silver went vertical. Futures markets were in chaos. Exchanges changed rules. Margins were hiked aggressively. But even then, the core issue was speculation overwhelming the system, not a prolonged structural drain of physical inventory combined with persistent global price divergence. Fast forward to 2008. Financial markets were collapsing, liquidity vanished, and retail silver products were temporarily hard to find. Coin shops ran dry, premiums spiked, but wholesale bar markets and exchange inventories did not show the kind of multi-year, relentless drawdown we are seeing now. That was a liquidity crisis. This is a supply credibility crisis. Then 2011, silver surged to nearly $50. We had margin hikes, violent price swings, and what many call the Silver Sunday collapse. Again, massive volatility. Again, heavy paper influence. But inventories were not sitting near multi-year lows, while physical demand in Asia was consistently bidding above Western prices for months on end. In a normal market, when inventories fall, prices rise until supply comes back. In a normal market, when one region pays more, metal flows there and closes the gap. In a normal market, arbitrage is not optional. It is automatic. But today, the arbitrage is dead. Not difficult, not expensive, dead. Can we not ship silver from New York to Shanghai? Of course we can. Can we not refine, recast, and transport 1,000-ounce bars across oceans like we have for decades? Of course we can. So that is not the problem. The problem is that the metal that is supposed to be available is either already spoken for, tied up in long-term contracts, sitting in strong hands that are not selling, or simply not there in the quantities the paper market implies. The paper system says supply is abundant because contracts can be created instantly. The physical system says supply is tight because bars cannot be printed. That is the breakdown. We have a pricing system built on leverage and derivatives trying to represent a physical market that is being drained in real time. The more stress builds, the more the paper side expands to keep prices orderly, and the more the physical side pulls metal off the market and locks it away. That feedback loop is unprecedented at this scale. It is not just a squeeze. It is a structural fracture between paper promises and physical reality. And when arbitrage dies, price discovery follows it. Now let me tell you what happened this morning that makes today's move even more significant. While inventories are draining and physical demand is surging, the exchange did not sit still. The CME, the group that runs the COMEX silver futures market, quietly adjusted margin requirements again. Not dramatically, not with a screaming headline, but just enough to increase the cost of holding long positions. They did this specifically to slow the momentum. They did this specifically to cool off the buyers. And most importantly, they did this to protect the banks who are short. Let me explain that. When prices rise in a heavily shorted market, the institutions that sold those contracts, often bullion banks like JP Morgan, HSBC, and Bank of America, start bleeding on paper, losses grow, risk departments get nervous, so the exchange steps in and raises margins. That forces traders to post more cash to maintain positions. Some cannot, some liquidate. Price pressure eases. That is the theory. And for about 6 hours, it looked like it might work. Silver dipped. Volume spiked. Headlines came out saying the rally had overextended. Analysts started talking about healthy pullbacks and technical resistance. It was the same script we have seen before: shake confidence, shake out weak hands, restore order. But then something happened. Physical buying did not stop. Premiums in Asia did not fall. Warehouse withdrawals did not reverse. Instead of cooling down, the stress simply shifted. Futures contracts sold off briefly, but bids came back fast. The dip was bought, the pressure returned, and the margin hike that was supposed to calm the market ended up highlighting just how desperate the situation is becoming. Because when you raise margins into a rising market and the market shrugs it off, that tells you something critical. It tells you the move is not purely speculative. It is being driven by real demand, by entities who are less sensitive to short-term price swings and more focused on securing metal. We have seen this movie before. In 2011, margin hikes were used repeatedly to break silver's momentum. Back then, it worked. The rally collapsed, and paper selling overwhelmed physical demand. This time feels different. This time inventories are far thinner. This time global industrial demand is stronger. This time Eastern buyers are more aggressive. And this time trust in financial institutions is weaker than it was a decade ago. So when the usual playbook, raise margins, spark a sell-off, scare the market, fails to produce a lasting drop, it signals that control is slipping. They tried to push the ball underwater. It popped back up. And that is not a sign of strength in the system. That is a sign of strain. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. In Shanghai, gold has been trading at a persistent premium to London pricing. Not pennies, dollars. That tells us Chinese buyers are not waiting for Western price signals. They are securing metal first and worrying about price second. The same pattern we are seeing in silver, physical demand overwhelming paper reference prices, is showing up in gold. In India, wholesale bullion dealers are reporting tightness in both silver and gold bars, especially larger investment sizes. Import volumes have risen, but local premiums remain elevated. That means metal is coming in and being absorbed almost immediately. It is not building into comfortable inventories. It is moving straight into private hands, jewelry fabricators, and long-term holders. Now look at the bond market. Yields have been volatile, with sudden spikes followed by sharp pullbacks. That kind of instability in sovereign debt markets pushes capital toward hard assets. When trust in government paper wobbles, gold and silver start looking less like commodities and more like monetary insurance. That flow does not always show up in futures positioning first. It shows up in vault withdrawals and bar demand. And this is where it gets really interesting. Industrial buyers are also stepping in. Solar manufacturers, electronics firms, and battery component producers have all increased long-term supply agreements over the past year. Silver is not just a monetary metal. It is a critical industrial input. When these companies sense supply risk, they do not speculate in futures. They lock in physical supply chains. That quietly removes metal from the float that might otherwise cushion investment demand. So we have three forces hitting at once. Investment demand in the East, monetary hedging as bond markets wobble, industrial users securing supply ahead of potential shortages. In the West, price is still largely discovered on leveraged futures exchanges. In the East and in the real economy, price is being discovered by who can actually get delivery. That geographic split matters. In Shanghai, buyers are paying up. In India, buyers are paying up. In Western paper markets, price is still being capped by derivative flows. That divergence cannot last forever. Either physical demand cools dramatically, or paper prices are forced to catch up. And when you see gold confirming the move, bonds flashing instability, and industrial demand quietly draining supply in the background, silver stops being just a trade. It becomes a signal. Now let me tell you about the $41 trap, because that number, the COMEX spot price flashing on your screen, is becoming one of the most misleading numbers in the entire financial system. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand. Your screen says silver is around $41 per ounce. Analysts say silver is range-bound. Financial television says there is no shortage. But walk into the physical market and try to act on that number. Pick up your phone right now. Call your local bullion dealer. Ask them to sell you 500 ounces of silver at $41 per ounce. Not a collectible coin, not a numismatic rarity, just basic investment-grade silver. They will laugh at you. Because in the real world, that same silver might cost you $46, $48, even $50 per ounce, depending on form and location. That difference, that $5 to $9 gap, is not greed. It is not random. It is a signal. It is the premium the physical market is charging because supply is tight and replacement metal is uncertain. In a balanced market, premiums stay small. $1 or $2 over spot for retail products, less for large bars. But when wholesalers start paying above futures prices just to secure bulk metal and retailers stack their own premiums on top, you are no longer dealing with a smooth pipeline from mine to mint to investor. You are dealing with friction, delay, risk. This is the decoupling. This is the moment where the paper market and the physical market snap apart. The paper market says, we have plenty. Trade contracts, roll them forward, settle in cash if you want. The physical market says, if you want metal, pay up, and maybe wait. That gap exists because paper silver can be created with a keystroke. A futures contract does not require a bar to exist at the moment it is sold. Physical silver requires mining, refining, transport, and vaulting. One is elastic, the other is stubbornly real. As long as most participants are happy to play the paper game, the spot price can stay suppressed relative to physical stress. But the more people who say, no, I want delivery, no, I want bars, no, I do not trust a promise, the more strain hits the system. And that is the lie. The lie is that the paper price represents reality for everyone. It does not. It represents reality for traders willing to settle in cash. It does not represent reality for someone who wants to hold silver in their hand outside the financial system. That gap between $41 on the screen and the much higher real-world acquisition cost is not a minor inconvenience. It is the warning light on the dashboard. So what does this mean for you? What should you do right now? Let me be very clear. This is the part where emotion has to step aside and strategy takes over. If you own physical silver, coins, bars, rounds, whatever form you hold it in, do not sell. Do not even think about selling. Not because I am predicting a straight line up tomorrow morning, but because the stress we are seeing is structural, not speculative. When physical supply gets tight and trust in paper claims weakens, real metal becomes more valuable not just in price, but in function. It becomes liquidity outside the system. Selling into early volatility is exactly how strong hands lose position to institutions that understand the long game. If you own silver ETFs like SLV or PSLV, you need to seriously consider your risk. I am not saying panic. I am not saying dump everything at the open. I am saying understand what you actually own. Do you own shares of a trust that may settle in metal under extreme stress, or do you own exposure that ultimately depends on the same financial plumbing that is already showing cracks? Paper vehicles can track price in normal times, but these are not normal times forming on the horizon. Read the prospectus. Understand redemption rules. Know the difference between backed by and redeemable for. If you own silver futures, you need to decide right now whether you trust the exchange to deliver if this situation escalates. Futures are powerful tools. They offer leverage, liquidity, and flexibility, but they are also contracts governed by exchange rules that can change under stress. Position limits can shift, margin requirements can jump, settlement terms can be altered. If your strategy depends on standing for delivery, you need to be mentally and financially prepared for turbulence in that process. And if you do not own any silver and you are thinking about buying, the question is not, should I buy? The question is, can I still buy what I want in the size I want at a reasonable premium? Because in tightening markets, availability changes faster than headlines. Products go out of stock. Wait times stretch. Premiums rise before the spot price fully reflects reality. Waiting for the perfect dip works in oversupplied markets. In tightening markets, dips get bought and inventory disappears. This is not financial advice. I am not telling you what to do with your money, but I am telling you what I see. I see a paper market under strain, a physical market firming, and a growing disconnect between the two. In that kind of environment, the biggest risk is not volatility. The biggest risk is assuming the system will always function smoothly just because it always has before. Preparation beats prediction. You do not need to go all in, you do not need to panic buy, but you do need to be honest about counterparty risk, delivery risk, and the difference between exposure on a screen and assets in your possession. Because when markets move from comfortable to stressed, the rules do not break all at once. They bend first, then they snap. Now let me address the elephant in the room. We are entering the final countdown phase of this move, and no, that does not mean a Hollywood-style explosion tomorrow at 9:30 a.m. It means the structure of the market is shifting beneath our feet, and once that shift reaches a tipping point, events start happening faster than most people are psychologically prepared for. Let me map this out in phases so you can see the progression. Phase 1 is where we are right now. I call it the last train. This is the period where metal is still available, markets are still open, and prices still look somewhat normal on financial screens. Inventories are falling, premiums are rising, and stress is visible, but the system is still functioning. This is the window where people who are paying attention can still act deliberately rather than react in panic. Phase 2 is what I call the void. This is where things get uncomfortable. Volatility spikes, exchanges may change rules, margin hikes become frequent, delivery timelines stretch, products go in and out of stock, headlines become contradictory. One day you hear shortage, the next day you hear plenty of supply. In this phase, price discovery becomes erratic because trust is eroding. Not gone, but eroding. Then comes phase 3. Call it Silvergeddon. Call it a delivery event. Call it a confidence break. This is the moment when the gap between paper promises and physical availability becomes too large to ignore. It does not have to be a total default. It could be a major cash settlement event, a force majeure clause invoked somewhere in the chain, or a sudden repricing as large players scramble for real metal at the same time. When that happens, price does not gently drift higher, it reprices. We have already seen analysts and fund managers start to float higher targets. $60 silver, $75 silver, even triple-digit scenarios if a true supply squeeze collides with monetary instability. I am not anchoring to a specific number today. What I am telling you is that the range of outcomes is widening, not narrowing. This is not a normal market cycle. This is a paradigm shift. A shift from abundant, trust-based paper trading to constrained, reality-based physical demand. And paradigm shifts are messy. They are volatile, they shake out weak hands, but they also create historic opportunities for people who understand what is happening before the crowd does. The timeline is not measured in years anymore. It is compressing into months, weeks, and key delivery cycles. Each inventory report, each margin change, each surge in physical premiums is another tick on the countdown clock. We are not at the end of the story. We are at the beginning of the part everyone will remember. So here is my final message to you. Inventories are being drained, physical premiums are rising, and the paper market is straining to maintain the illusion of balance. The gap between promises and reality is widening, and history shows that when that gap finally closes, it does not close quietly. The time for debate is over. The time for watching is over. The paper market is dying. The physical market is taking over. You are not crazy for seeing this. You are not early. You are informed. And if you are holding physical metal, you are holding the kind of asset that does not depend on a counterparty's promise to exist tomorrow. Do not sell. Do not let them steal your metal with volatility. Do not let them shake you out with paper price games while the real supply gets tighter behind the scenes. The target is higher. The timeline is accelerating. The fundamentals are undeniable. This is paper to atoms. If this video opened your eyes to what's really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse, like this video if you're holding physical and you're not selling. Share it with anyone you know who needs to understand what's coming. The mainstream media won't tell you this. Your financial advisor won't tell you this. But I will, every single day on Paper to Atoms. And here's a question for you. Leave it in the comments below. Are you holding physical or paper silver right now? I read every single comment, and I'll see you in the next update. Remember, get out of paper. Get into physical. Go, go, go.